A confirmed SSA update verified within the last 72 hours shows March Social Security payments are carrying a 2.8% cost of living adjustment that added $56 per month to the average check. But CMS data shows nearly a third of that increase was immediately absorbed by a Medicare Part B premium hike most seniors never saw coming. The real dollar difference landing in bank accounts this month is not $56. It is closer to $38. And if your March deposit felt lighter than the raise you were promised, this update tells you exactly where the rest of it went. This update is for seniors who noticed their March deposit went up, but the increase felt lighter than expected, and for anyone who wants to understand what the 2026 adjustment actually delivered after every deduction cleared, and what they can do right now to stop losing any more ground. 2 days ago, I received a message from a 67-year-old retired nurse named Sylvia from Louisville, Kentucky. Sylvia worked in the cardiac unit of a hospital for 29 years, cared for patients through the hardest moments of their lives, and told me she retired the day she hit full retirement age because she had been counting down to that date for years. She did her homework before she retired, read everything she could find about Social Security, and went in feeling like she understood exactly what her monthly income was going to look like. Then January arrived, and Sylvia sat down with her bank statement and her notepad the way she does every month, and wrote her new Social Security deposit next to her old one. She had already done the math before the new year, figured out what 2.8% of her previous benefit would produce, and written that number at the top of her page. But the deposit that arrived in January, and again in February, and now again in March, was noticeably short of that number. Her electric bill was on the counter, her prescription costs had gone up. She had planned around a specific dollar figure, and the figure that arrived was not it. She mentioned it to her daughter, who told her she was probably misremembering what her old check was. Sylvia pulled 4 months of bank statements and confirmed she was not misremembering anything. Her check went up, just not the way it was supposed to. She wrote to me and said, "I know something is off, and I cannot get anyone to explain it to me in plain language. My raise arrived, but it did not feel like a raise. Where did the rest of it go?" Sylvia, I can tell you exactly where it went. Let us start with the 2026 cost of living adjustment itself, because the number the SSA announced and the net dollar amount that actually lands in most seniors' bank accounts are two different numbers, and the gap between them is the thing Sylvia noticed, and that millions of other beneficiaries have either not caught or have quietly accepted without understanding what produced it. The SSA confirmed a 2.8% COLA for 2026, calculated using the Consumer Price Index for urban wage earners and clerical workers, which is the specific inflation measure that federal law requires the agency to use for this calculation. For the average retirement benefit of $2,015 per month that was in effect at the end of 2025, a 2.8% increase added approximately $56 per month, bringing the average check to $2,071 going into January. That adjustment was applied automatically to every beneficiary already receiving payments, and it did not require any action to receive. That part is real, and it is confirmed. The SSA announced it, applied it, and every beneficiary receiving Social Security in March is receiving a check that reflects it. But here is what the official COLA announcement did not lead with, and what the headlines celebrating the raise consistently buried at the bottom of the story, if they mentioned it at all. On November 14th of last year, the Centers for Medicare and Medicaid Services announced that the standard monthly Medicare Part B premium for 2026 would be $202.90, an increase of $17.90 from the $185 that beneficiaries had been paying in 2025. That is a nearly 10% increase in the Part B premium in a single year, and for the majority of Social Security recipients who have their Part B premium deducted directly from their monthly benefit, that $17.90 increase came directly out of the same check that the COLA had just added $56 to. The math is not complicated and the result is not subtle. $56 added, $17.90 taken back. Net real increase landing in Sylvia's account and in the accounts of tens of millions of seniors across the country, approximately $38 per month. According to research published by the Center for Retirement Research at Boston College, the Medicare Part B premium increase for 2026 consumed nearly one-third of the average retiree's full COLA dollar increase before that money ever cleared a bank account, and 2026 is not an isolated year in this pattern. The Senior Citizens League, a nonpartisan advocacy organization that tracks Social Security and Medicare data, has documented that 2026 marks the third consecutive year in which the Medicare Part B premium increased at a faster rate than the Social Security COLA itself, which means 3 years in a row, the program designed to protect seniors from inflation delivered a raise while simultaneously allowing a deduction to quietly reclaim a significant portion of it. This is the reason Sylvia's notepad did not match her bank statement. It is not because the SSA made an error. It is not because her benefit was calculated incorrectly. It is because there are two separate numbers in play, the gross COLA increase and the net amount remaining after Medicare, and most seniors are never told the difference before they see it reflected in their deposits. Now let us talk about why the COLA itself, before any Medicare offset, is a subject of serious ongoing debate, because this is not just about 2026, and it directly affects every dollar Sylvia and every other senior will receive for the rest of their lives. The COLA is calculated using a measure of inflation called the CPI-W, the Consumer Price Index for urban wage earners and clerical workers. That index tracks the spending patterns of working-age urban households, people who are actively employed in clerical or wage-earning positions, and it was the only official price index the government produced when Congress wrote automatic COLAs into Social Security law in 1972. The CPI-W has been used for this calculation ever since, not because it is the best measure of what seniors actually pay for the things they actually buy, but because it is what the law specifies, and changing it requires an act of Congress. The problem, documented extensively by economists, senior advocacy groups, and the Bureau of Labor Statistics itself, is that the spending patterns of working-age urban employees do not match the spending patterns of retired seniors in retirement. The CPI-W places relatively heavy weight on categories like transportation, apparel, and employment-related expenses that retirees spend little on, and places comparatively lighter weight on healthcare, housing, and prescription costs, which are precisely the categories where seniors spend a disproportionate share of their fixed income and where prices have risen most aggressively over the past 2 decades. The Bureau of Labor Statistics has developed an experimental alternative called the CPI-E, the Consumer Price Index for Americans 62 and older, which weights healthcare and housing more heavily to better reflect how retired seniors actually spend their money. Research from the Bipartisan Policy Center and the SSA's own Office of the Chief Actuary has estimated that if COLA calculations had been based on CPI-E instead of CPI-W, the annual adjustments would have averaged approximately 0.2 percentage points higher each year. That sounds modest until you consider the compounding effect over a full retirement. The Senior Citizens League calculates that a person who retired with average Social Security benefits in 1999 has lost an estimated $5,000 in cumulative purchasing power, specifically because of the CPI-W versus CPI-E difference, and the gap for someone retiring today could ultimately reach $12,000 or more over the course of their retirement if the formula is not changed. Bills to switch the COLA calculation to the CPI-E have been introduced in Congress multiple times under both parties, and as of today, none of them have advanced past the introduction stage. Meanwhile, the underlying reality of what seniors are paying continues to diverge from what the COLA is designed to offset. HealthView Services, a firm that tracks healthcare costs in retirement, published data showing that healthcare-related inflation is running at approximately 5.8% annually for a 65-year-old couple retiring in 2026, compared to the average Social Security COLA, which has averaged approximately 2.4% over the past decade. At that pace, the same research estimates that a healthy 65-year-old couple retiring today would need to devote roughly 84% of their lifetime Social Security benefits just to cover medical costs. That is not a projection designed to alarm. It is a data-based estimate of where the trajectory leads if current trends continue, and it is why the $38 net increase landing in Sylvia's account this March is not just a math story, but a policy story that directly affects every fixed-income senior in the country. So what can Sylvia and every other beneficiary do right now, given the reality of where the numbers stand? The first thing is to verify that the base benefit itself is correct before addressing anything on top of it, because an error in the earnings record that underlies the benefit calculation compounds forward through every COLA and costs money indefinitely. Log into your My Social Security account at ssa.gov and review your complete earnings record year by year. The SSA calculates your benefit from your highest 35 years of inflation-adjusted earnings, and if any year in that record is missing or recorded lower than what you actually earned, every COLA being applied on top of that lower base is producing a smaller dollar increase than it should. Correcting a single year's earnings error not only raises your base benefit, but raises the dollar value of every future COLA you will ever receive, which means it compounds in your favor for the rest of your life. The second thing worth investigating is whether your Medicare plan is actually the most cost-effective option available for your specific health situation, because Part B is not the only Medicare cost that gets deducted from Social Security. Medicare Advantage plans vary significantly in their premium structures. Some charge additional premiums on top of Part B, and some charge nothing. And for beneficiaries who qualify for a Medicare savings program, there are income-based programs that can cover the Part B premium entirely, which would mean the $17.90 increase that offset Sylvia's COLA would be covered by the program rather than subtracted from her check. The Medicare Rights Center maintains a free national helpline at 1-800-333-4114 that can help beneficiaries identify which programs they qualify for at no cost. The third thing every beneficiary should know is that if your income has changed significantly since your last tax filing and you are currently paying an IRMA surcharge on top of your base Part B premium, you may be eligible to request a reconsideration using IRS Form SSA 44 and have that surcharge reduced or eliminated. IRMA is the income-related monthly adjustment amount that pushes Part B premiums above the base $202.90 for higher income beneficiaries, and it is calculated based on tax returns filed 2 years prior, which means a major income change such as retirement, the sale of a home, or the death of a spouse may not be reflected in your current premium calculation, even though your current income is substantially lower. Filing Form SSA 44 with documentation of the income change can bring your premium back down to the standard rate and restore that money to your monthly check going forward. There is one more protection that a meaningful number of Social Security recipients in 2026 are leaving on the table, and it specifically relates to the Medicare premium side of this equation rather than the COLA side. If you are currently paying more than the base $202.90 Part B premium because of an IRMA surcharge, an income-related adjustment that pushes premiums as high as $689.90 per month for higher income beneficiaries, and your income has dropped significantly since the tax year that IRMA is based on, you may be entitled to have that surcharge reduced or eliminated right now. IRMA is calculated using tax return data from 2 years prior, which means a major life change such as retirement, the death of a spouse, or a significant reduction in investment income may not yet be reflected in your current premium, even though your income today is substantially lower than the figure SSA is using to set your deduction. Filing IRS Form SSA 44 with documentation of the income change can bring your premium back to the standard rate and restore that money to your monthly check going forward. For someone paying the first IRMA tier at $284.10 per month instead of $202.90, a successful reconsideration means recovering an extra $81.20 per month, which is more than twice the net COLA increase that most seniors received this year. And before your next payment date, verify your direct deposit information is current at ssa.gov. With the staffing reductions at SSA that have been in effect since early 2025, a payment sent to an outdated or closed account is taking significantly longer to recover and reissue than it has historically, and a delayed payment for someone budgeting around a fixed monthly deposit is not a minor inconvenience. Paper federal checks no longer exist under the executive order that took full effect in late 2025. Direct deposit or a Direct Express debit card are the only options, and if you have not set either one up, your payments are being held right now. Call SSA at 1-800-772-1213 or visit ssa.gov to resolve this before your next payment date. If you are not yet subscribed to U.S. Pension Insight, please hit that subscribe button right now. It is completely free, and every update exists to give you straight answers before it costs you money. The 2026 COLA added $56 per month to the average check, bringing it to $2,071. The Medicare Part B premium rose $17.90 at the same time, from $185 to $202.90, absorbing nearly a third of that increase before it reached most accounts. Net real increase for the average beneficiary, $38. The COLA is calculated using CPI-W, which tracks urban wage earners, not retired seniors, and switching to the CPI-E is estimated to prevent thousands in cumulative purchasing power losses over a full retirement. Sylvia verified her earnings record and found a year where her wages were underreported. She has an appointment with SSA next week. She told me, "I spent 29 years taking care of other people and never thought I would have to fight this hard to understand my own check, but now I know what to look for." That is exactly why this channel exists. Stay subscribed. I will see you in the next update.